Hey fellow traders, hope this video finds everyone doing well. If not, be sure to subscribe and check out my other videos on my channel, especially if you're new to trading. I talk about a lot of topics and I have a lot more planned. I'm going to be doing a few other things in the future here with uh, showing quite a few different situations and problems and ways to solve them, and basically try to help you become a much better trader. In this video, I want to show you guys a very simple strategy. This is one that I've been kind of learning to trust a little bit better as time goes on, because that is probably about the only real problem I've had with this strategy, is just simply trusting it. So I'm currently working a little bit with NinjaTrader on futures to try to check it out there. But I have been actually running it on demo a lot with Forex and getting a lot better on it with that pair. But it seems to be working the same all the way through. Now, what I have already drawn up are two sets of patterns. And with this strategy, you're only going to be basically looking for uh, just this particular pattern or this particular pattern. And I'm going to get into a couple of little rules and things uh, to kind of help you with what to do with your entries, your exits, how to use a trailing stop, and then we're going to go kind of over the chart and look at it. Now, this is going to be a strategy that can work in a little bit shorter time frame, although you could actually see this play out on higher time frames as well. You'll just have to allocate a bit more risk. And we'll actually go over that in this video as well. But let me clear this off, and I'm going to go ahead and pull up the actual strategy. So basically, this would be that two candle pattern. This would be the two candle pattern. There's another example of it and another example of it. You're only going to be looking at two candles at a time. And generally, you're going to want to wait for these candles to close, but sometimes during the entry, you may want to basically enter at the closing point of the low of the green candle if it's going red and you're trying to go short. And then basically you're just going to follow this down until you have a close of a candle above the last high of the other candle. So basically once it clears here, you want to exit. Now, sometimes you may want to wait for this candle to close. Other times you may want to just take it out directly at that high point. But I have these circles around the wicks of each candle, because what you'll notice on most charts, when you're in consolidation, these kind of wicks and highs and lows, things like that, do not matter. But if this was more red candles before this, you could see where a wick gets broken, but it doesn't break the overall trend. And then once it does break that green candle, basically you have a color change to go short. That's you would want to start looking to enter anywhere below here. And your stop would go basically above these points if you were looking to trail, because anytime you have a close above, or if price breaks that wick, even with the wick in the next candle, generally that's a sign you're going to start looking for something like this. So you would want to try to enter at the high of the open of that red candle if you're going long, and you would want to enter short the same way here, but you would want to go with the open of the green candle. If price passes, you would want to open your short there. And we're going to look at the chart, because this does actually play out to be quite an effective strategy. The only little real detail, other than these couple of points, I've kind of marked out here on the long, that's a little bit clearer here. So we'll just go ahead and review this real quick just so I can clarify the whole picture. But let's say you were not in a trade, and even if there were reds, it doesn't matter what's before this at all. You're going to have a red candle, and as soon as that close is broken, especially if it's closed above, you kind of want to anticipate your entry a little bit here, especially if it breaks that wick. but then you will take the entry and your stop would go below the lowest point. And I've got a couple other examples to show what you're going to encounter, but it's going to basically cover 95% of everything you're going to run into, because I've been pretty much practicing this one quite exclusively here for a few moments, and actually have used it as well while dealing with this computer issue. I'm going to do some serious practice with it now that I have a way to actually run a computer that's not cooking itself. But once you take this entry, you're going to want to try to anticipate that long. Try to enter here or as close to here as possible. Even if it closes, you could try to wait and see if it comes back, then enter on this candle. But your entry, you're going to want to try to get it close to this level. And then your stop is going to go below the lowest wick or lowest point. So if there are no wicks here, your stop would basically go below here. Or below here, same example. Just imagine this and this tied together. And then as price moves up, once this candle closes, you would move your stop to below this wick. And then once you start to see some good movement, oftentimes you may want to go ahead and take profit or go ahead and close the trade after a certain bit and then wait for a signal. I kind of find it's better to practice a little bit and see what you kind of get on average in your gain. So like if you see, for example, 17 pips pretty commonly, but much more than that you don't see too often, you may want to just consider automatically cutting your profits at 17 pips, for example, because that's what you typically see quite frequently, and that in itself will help you take in more wins. Even though you're not hitting those small, or you're not hitting those large home runs, your 520s still makes $100. So that's kind of how you have to look at this system, because you're going to get a lot of small bits and pieces, but when you do lose, you're going to lose a very small amount. So if we're taking a look here at what your risk would be, so at first you're kind of risking just this small portion here, and then as price continues, you're going to move it up, and then you get into the clear. But if you look at the distance between here to here, it's going to be a little bit smaller, but usually you will see at least a 1 to 2 from here to here. So that's why I kind of suggest looking towards maybe considering taking profits instead of trying to maximize every single pip. But there are quite a few instances where using this you can trail and get some pretty long trades, especially when the market is going in one direction for a while. But once you run into this point here where that green candle, if that wick is broken, this trend is now over. And it is probably going to either go down, or we could consolidate for a while, because when you're in consolidation, this stuff kind of does not work. So if you notice price is kind of just going back and forth, you may want to wait for it to move out into a clear area, and then you may want to get in on a second candle. So you may want to, for example, if this was a consolidation and it broke out, you see the candle forming and it continues to break, you may want to try to get in here, write it down, trail your stop. Now you have a very small stop here, and you could either get out here, which would give you a close to a 2 to 1 example, or you could just take it once this candle closes. Once you get 2 to 3 candles in a row, usually a lot of traders like to use the rule of 3. So when you get 3 big candles, generally you'll take profit near the close of that third candle or that third push, because sometimes you can hold and it may come back. Because see, this could break here. Now you end up running into this situation. You get a little bit of a green, and now you're coming back, and that would end up coming way back all the way to your stop if it did something like this on the other side. But it will generally continue going in this direction until that wick is broken. Then it will go this way until that wick is broken, and so on and so forth, unless, like I say, it's going in consolidation. So the only other thing that we need to talk about are the pen bar candles, or the hammer candles, and the dojis. So these are pretty much the 3 situations you're going to run into. If you ever have something like this and you end up with a doji, you're going to completely ignore that doji and still follow the rule as if this candle were in play. So if this closes and you get a doji and you're looking to go long, you're going to look to go long here and not try to do anything with this doji, because you may end up with a situation like this where everything stays inside and then continues downward. So this right here, you kind of have to stick with your previous full candle. You don't want to really use the doji. And if the hammer is actually inside the other candle or upside down, so if you're on a downtrend and it also closes down, it doesn't matter what color this is. It's not going to matter at all the color. It's kind of the same idea here. There's indecision. There's nothing really going on. But in the situation with the hammer here, this situation is same. It's the same. It's not going to matter what color this is. It's going to be red or green. But if you have a hammer candle and the wick goes outside of the area of that last candle and then comes back up, that's generally a sign you're going back the other way, and you're still going to follow the same rule. Enter at the top of this candle here for long, put your stop down below the lowest point, and continue trailing it up, or just wait until you see a situation where you have that cancellation, where you have a close red that either closes below this open or this wick gets broken. So that would be your exit signal, and also an indication that you could also potentially enter short, cover your high point, the highest point. So if this is higher than that point, you would cover this point, but if this point is higher than that point, same deal there. But you're only going to worry about the point before it. So for example, this was the high of this candle. We had our green, and then we went and broke and gave our entry signal for our short trade. So now all you're doing is looking at these two wicks. If this wick is higher than that wick, then your stop goes above that wick, and vice versa. If this wick were sticking up way up here, you may want to cover the top of that wick. Even though it's near this area here, it is the highest of the two candles that we're working with. So you're going to work with the most recent closed candle and the one immediately before it. Everything else does not exist. So in this case, you had a red candle. It does not matter if this was green coming up to it or red coming down to here. If you have a full-bodied red candle and you have a break of this wick, or if you just start to show signs you're going above, you can enter anywhere in this area here. Just keep in mind that the higher you enter, the smaller this area will be. And now the best way to work with this strategy is to pick a single size and do not change the size at all. The main benefit to this strategy is keeping everything simple, keeping everything kind of straight line and narrow. You don't want to have a whole bunch of different variables. You don't want to have to keep calculating your position. You're just going to work out what type of pip value or point value makes you comfortable and kind of adjust that. So like if we see these candles and these candles are 10 pips a piece, then we need to figure if we want to risk $10, we may not want to trade higher than a 0.1 or 1/10 of a lot. For example, on Euro USD with US currency, because then you're going to be trading at basically 10 cents per point or $1 a pip. So if these are, 6 to 10 pip candles, you could potentially end up risking, or losing, $6 to $10 at that point value. So you would kind of adjust according to that and just kind of judge what time frame you're looking at. And I have this note here where it says 5-minute plus candle, 5+ minute candles. You're going to want to try to use this strategy on at least a 5-minute candle. And I would not really look at going much higher than the 1 hour candles to try to apply this. But I do see quite a few different examples, even in Bitcoin, uh, where we're trading that now, where you could potentially run that strategy and scalp out quite a few different gains or even ride some trends for quite a while. You have very few false signals in here, but we'll go ahead and start. This is even just the 1 hour chart, but we're still just going to look for that particular pattern a little bit at a time. So, when it's consolidating, notice that these wicks are kind of all over. The closes, the up down is a little bit different. But now notice what happens when you start to break out here. Notice the wicks, how the wicks are not broken at all until we get to this red candle here. Then that wick gets broken, and notice we travel down a little bit. Now we have the break up, so you could have gotten in long at this point, taking it up a little bit, but then we're starting to get a entry short signal here, so that would be a small win. But this would be an example in the 1 hour chart. I'm going to pull up the 5. We'll get quite a lot more examples. And I would not recommend going any lower than a 5, because it is probably going to give you a lot of false signals, and you're not going to get a lot of travel room out of each trade. This would be a good example here. You could even work with some of these small bits, like we can take an example look at here. Notice the wicks and the height of each candle. It kind of broke a little bit there. It would have gave a false long, but then you start breaking down and get the short signal, so it would have been a small loss in that instance. Or you could have chosen to stick with your original risk and just wait to give it some time to go down, or trail it down, stop out, take the small loss, but then you enter short again, continue trailing. And I'll make this a little bit bigger so we can look at what we're focusing on. And this is even just a small move on the 5-minute chart. So you could have then recovered and made more than what you lost. And this is why picking one size and sticking to it is important, because you may have only lost 1 or 2 pips here, or just a few pips here, but look at how much more you're able to gain back, which is going to heavily outweigh that little loss you took there. You may have also jumped in here long and trailed up, and then once that wick broke, now you may be short from there, and now you're just covering your high, and you're just starting to notice, and you could have actually made it through that with a win as well. It just kind of all depends on the way you're, where you get in at. And I kind of sometimes refer to it, when I find myself finding getting it wrong a few times in a row, I just kind of feel like I'm out of sync with the market, and I'll just stop and wait for something clean. This would be a good long entry example here. You have that pin bar, so once we break above, you may have wanted to enter there. You would have had to cover here, but then you could see that it's starting to come down and clear. And after a couple of candles, if it did do that, I probably would just go ahead and get out of that and take that as another short signal. Go again. Then we get the small bit here. You trail up, could have broke even there, flipped around and got here, taking that, and now we have the green candle here. Once that was broken, once that gets broken back that way, then you cover your stop this way, go back up. You could decide to hold through here just because you have a big candle. Then we start getting small. Notice we have all the dojis, small candles, not a lot of movement. Then it just continued. And then at this point, you could have chosen to stop out below this candle instead of trying to follow up, because we just left out of consolidation, and you may think it will consolidate again and then continue. So that's kind of a little discretionary call. But then we have these same examples here. And it just kind of carries on. And then here's another great example where, say for example, you wanted, there was some news here, it popped up and you missed out of that trade. Just ignore what this is right now. Price does not matter. We're looking at the candle pattern itself. So let's say for example some news happened here. Then you get that red candle, and say you didn't want to risk trading the news for slippage or whatever reason, you could wait till after. Now when you start, once this candle closed and started to rise up again, you could have taken a long entry here. Then you would cover this low wick area here, because out of the two candles, that is your lowest point. Carry it up, keep your stop below there, and you could have held this all the way up to here, and then once you get that strong red, that candle pattern that we look at, now you have a short, you can hold here, and you can hold through this, see if you're going to get that, and then you start getting the reaction back. Sometimes you can see these inside. You could decide to, if you see a second green candle, if price opens and starts to come up after this example here, this will be the only thing I didn't have drawn up. So if you have a green here and a second green starts to form, it opens and starts moving up, and you're short, you may want to get out of that. If you're waiting for an entry, that would be a potential way to get in. You have the color change, and then it starts to continue. Cover your low here and follow it up same way. Boom. That low doesn't get broken. That's a little bit higher, a little bit higher, a little bit higher. Notice how the wicks the wick of the current candle will not break the wick of the previous candle, and once it breaks that wick or low point, notice what happens. Now we've kind of disturbed the market, but then it starts to form again. And in this situation here, we could have gotten chopped a little bit, but then taken our entry there, picked up whatever we got taken out here, and we could have gone 1, 2, 3, and even closing out that bit, we probably would have canceled out what we lost going through some of this, or we may have just decided to come out there and trail up, or however. See, like these little areas are about the only ones to watch out for. So if you do start to see some stuff like this, and like you find yourself swapping 1 or 2 times, you may want to just sit and wait it out to see if you get a break, and then try to judge from there. It could be a good idea to wait and see if this would continue onward, especially with it already moving up. So a few things you'll start to get practice with and experience, and you may be able to filter out some instances. But for majority of the times, you're still going to see that same layout, that same persistence with the wicks, the highs and lows not being broken. And once they are broken, things change. See, we were moving up here. It's an open of a day, but we were moving up here. Wick is broken, carried down. Wick gets broken, we carried up. Wick gets broken, carried down. So once you see that wick break, you can have a high certainty that you're probably going to flip direction, or you just want to get out and wait to see if you get another clear signal. But it is going to give quite a few small trades a lot of times, especially if you're in a heavy news week. But if you're in situations like we're looking at before, where you have news, or you have something that's already continuing, you can confidently get in and only risk that one candle. So even if you got in up here, you risk right around there, continue to follow up, and you still could have pulled in a 2, 3, or even 4 to 1 off of that. But we're not looking to make our risk the same dollar amount, because this distance is going to change. This is a lot bigger than this area for where we would enter. So you would constantly change your size, and this is therefore going to change how fast your account changes in relation to the market, and it's another variable that's going to make it very difficult for you to be profitable. I highly recommend picking a set size, a set pip value, and run this one pip for pip, and only worry about counting pips, not counting dollars. Because ultimately, as you can see in several different places, and even if you were to wait for a specific high volume session, you can see that the losses, even directly looking at the candles, it wouldn't be too hard to keep up with. The hardest thing, like I say, is trusting it, because you're going to have this start running backwards. In order to make these wicks, you have to make red. And as you keep seeing red, or it's going to go up, and you're going to see red as it's coming down, then you see more red. But if you follow and trust that stop rule, you could have potentially rode at least 65 to 80% of this move. You may have tripped out there, but then got back right. and recovered more, way more than what you would have lost here. And had you taken the entry short there, covered there, got that candle, covered there, it would have been hard to lose a whole lot in that situation there. You wouldn't have won, but you probably wouldn't have lost very much either. And then same situation. So now you see the wicks. We went over the wicks and how they were gradually rising. It never gets violated, and once it's violated, the market changes. So just very simple, straightforward, the 2 candle pattern. That's it. That's all you're looking to do. So, you saw in the example there how the wicks worked, how we're looking to enter, what type of exits we're looking for. You could either wait for a couple of more candles and just take the average of what you typically see anyway in your practice. So like I say, if you're practicing on the Euro USD and you commonly see that, okay, we get about 8 to 9 pips out of these moves, I'll just go ahead and take it at 8 or 9 pips instead of waiting for the stop loss to get hit and only take 4 pips. So that could actually help you, because the more that you're able to get in forward progress in terms of pips, the less you have to worry about losing. So, and then by sticking with that same size, so if I take this trade and I lose, 4 or 5 pips, then I lose another 4 or 5 pips, but then I catch one of these and wow, I make 20 pips. Well, now I've got 2 to 1 against what I lost in just one trade. So that's where this sticking to the same size and just kind of following it along, and even just trying to trade in the higher volume sessions. I've even done this in Tokyo quite a bit, and the other day I didn't do anything today with it, but yesterday I actually ended up making 3.5%, just in a 24-hour period from Wednesday, basically just Wednesday, or no, it would have been Thursday in the market, Wednesday night to Thursday night my time, but Thursday in the market. So on Thursday, just trading Tokyo sessions only, I still managed to make 3.5% on the account. And I'm using a $150 account with just a 0.01, not changing size, and was able to do that. So now I just take that and multiply it by however many times to make the amount of money that I'm going to put in and use the strategy with, and I'd work the sizing out the same way. So basically you can take $150 and divide that by however much your balance is. So let's say, for example, you have a $1,500 account and you wanted to trade using a rule of thumb type risk and just use the same size. You take $150, divide it by 1,500, you get 10. So you may want to trade with a 0.1, which will give you $1 per pip, or 10 cents per point on Forex. But this strategy works the same in futures, as I found out today. Didn't make any wins because at first I wasn't trusting it, but once it was all said and done, 84 cents green. Not a win, not a loss, that's fine. I didn't move today, no problem. At least I didn't donate. So that counts too, even though I still kind of count that as a bad day. So a little over a month of trade, about a month of trading in that, I've had 4 bad days so far. So about 1 per week, 1 every 5 is average what I'm expecting. So I'm doing quite well on schedule, but I'm still going to practice anyway. So I'm going to end this video and wrap it up here. Make sure to leave those likes and comments to help the algorithm, help the channel grow. Subscribe to catch more videos, and I'm going to go practice. I would recommend checking this out and seeing what you could do with it, and just kind of study your chart, look for examples. But this is basically the whole strategy in a picture. Just go between the 5-minute candles all the way up to the 1 hour. I say I wouldn't advise going much higher than that, because then your risk and your the amount your account changes is going to be rather drastic and significant, and you may need to trade with a much smaller size than what I recommend. But if you're sticking between 5 minutes to an hour, you may want to use a 0.01 per 150 or 0.01 per 200, even all the way up to 250 respectively. Just know that the higher the rule of thumb number you use for your sizing, if you're going with like for every $250 you use a 0.01. So if you have $1,000, you trade with a 0.04. You know, you're going to incur smaller losses, but you're also going to incur slower gains. You have to risk it to make it, unfortunately, and that's going to work no matter if you change your size or you stick with the same size. But I highly recommend sticking with the same size to use less variables. So, just a few tips for that. And like I say, for example, you know, if you had $1,000 account, but you were using the rule of thumb of 0.01 per 150, in that instance, just do it on the calculator so we know we're absolutely correct. So you would be using a 0.06 because you'll basically just take this whole number, so 6 times 0.01. So you're going to use 6.01, so that will give you a size of a 0.06. So 0.04 to 0.06, it doesn't seem like much, but again, 5 20s makes a single $100 bill. So just keep that little analogy in mind. This is going to give you a fairly high hit rate, even though the trades will be small. But eventually, by taking a small bite out of it at a time, you can very quickly compound your account. And even just a few percent per day, if you're getting 2 to 3%, because you're sitting down for an hour or two to do this, and if you're getting, you know, between 2 to 5% per day, you're going to double your account very quickly. That's just one of the side effects of compounding. So, yeah, 3% or 3% on 100 is $3, but 3% on $200 is $6. So the bigger you get, the faster this is going to snowball. And try not to look at it in terms of P&L. Just look at it as making a consistent gain of pips. Gain more pips than you lose. And as long as you are making more pips positive than you are giving up negative using the same size, you will, of course, be making profit because you will have a positive pip gain. So I'm going to wrap it up here, and I will catch you on the next video.